India has the largest, youngest population on the planet. Now imagine all the young people, especially the most economically and financially vulnerable ones, take loans at exorbitantly high interest rates, much beyond their abilities to repay them. Let me tell you that this is very easily possible considering the vulnerability of the younger lot and lack of regulations. Go online and with a little bit of research, you can personally meet victims and their families who have taken loans at exorbitantly high rates from relatively unknown apps or loan companies. Hello, my name is Abhinav Trivedi and you're watching Mint Explains. Now, a little research will tell you that at many registered non-banking financial companies or NBFCs, loan spreads, which is the difference between average interest rate and market interest rate, were above 14%. So actual rate of interest which the customer pays could be as high as 35 to 40%. You heard that right. Can you believe that? Now, over the years, the Finance Ministry and the RBI have taken cognizance of this ecosystem. Thousands of Chinese loan apps alongside illegal betting apps had emerged in India post-COVID. They were later banned after strict enforcements by the regulators. Now, a few days ago, RBI Governor Shaktikanta Das had warned the non-banking financial companies and microfinancial institutions that chasing growth at all costs threatens financial stability of the country. He said, and I quote, "It is observed that some NBFCs are aggressively pursuing growth without building up sustainable business practices and risk management frameworks commensurate with the scale and complexity of their portfolio. An imprudent growth at any cost approach would be counterproductive for their own health." Now, the governor also raised concerns about microfinance institutions and housing finance companies imposing illogical interest rates and frivolous penalties on their customers. He said that these practices are sometimes further accentuated by what appears to be a push effect, as business targets drive retail credit growth rather than its actual demand. The consequent high cost and high indebtedness could pose financial stability risks. Now, the Reserve Bank of India has closely been monitoring these areas, and the regulator has insisted that it will not hesitate to take appropriate action if necessary. Now, RBI data shows that the gross non-performing assets and net NPA ratios of the NBFC sector as of June 2024 were 2.6% and 1.1% respectively. This compares with 3.2% and 1.2% in the same quarter previous year. Now, in the Financial Stability Report published on June 27th, the RBI highlighted that the Indian economy and the financial system remain resilient as the gross NPA ratio of banks has declined to a multi-year low. The gross NPA ratio fell to a 12-year low of 2.8% at the end of March 2024. Now, the scheduled commercial banks or SCBs net non-performing assets ratio fell to 0.6% at the end of March 2024. Now, recently, the Reserve Bank of India had temporarily barred 4 non-banking lenders: Sachin Bansal's Navi Finserv, DMI Finance, Asirvad Micro Finance, backed by Manappuram Finance, and Arohan Financial Services from sanctioning and disbursing new loans from the close of business on 21st October. Now, there were many reasons cited by the RBI, but the main reason, as per the RBI, was that the lenders failed to follow the Fair Practices Code, violated rules around income assessments, and disregarded loan repayment capacity norms for microfinance borrowers. The RBI report also mentioned that the inspections also uncovered concerns related to evergreening of loans, asset classification, gold loan portfolio practices, and non-compliance with disclosure mandates. Additionally, some of these NBFCs had also outsourced core financial services, compounding regulatory risks. Now, the bigger question is, what is the source of funding for a lot of NBFCs and microfinance institutions or loan apps? Not just these, but all of them. Is it banks? Is it sovereign funds, covert crypto tools, or just pure VC play based on excess profits and shareholder value? More importantly, what tools are being used to lure in vulnerable customers? No documentation, complete intrusion of privacy, where all your contacts and Aadhaar details are published online, credit cards, instant loans, buy now, pay later, or loan against assets like property. You see, for certain NBFCs and microfinance institutions, pure profit is the only play. In fact, as per Mint story, Sachin Bansal's Navi forces you to share all your contact details. Overall, however, RBI has stressed that the health of the banking and NBFC sector continues to be strong. Thus, also highlighted build-up of stress in a few unsecured loan segments like loans for consumption, microfinance loans, and credit card outstanding purposes. These are systemic risks and can pose threat to an entire economy, and that's why the RBI is concerned. This is a vulnerable sector which involves economically vulnerable population, and the risks can be much more than all of us can imagine, and that's why RBI is concerned about these activities. We at Mint shall keep you posted. Bye-bye.